And very interestingly, this week I've got a very, very nice question that's come through from one of the members, which is brilliant. Yeah, I think it's given me something to talk about, and it's also kind of uh, reminded me to go back over my own principal understandings and look into things for you guys. So where we're going today, in essence, is a question that's come through from a member. Now, before I get to this, I think it's important to just point out and just mention something to you guys. We did have an issue this week where there was one of the members pointed out there was someone mimicking my Twitter feed, trader underscore Bran. Now, what I would say, guys, as a rule of thumb, okay, I have no intention to ever reach out to any one of you. Not because I don't think you're nice people, but because I've got a full-time job, which is trading. And the same goes for pretty much anyone at Axia, okay? We're not in the market to come and hound you guys with, you should do this course, you should do that course, you should use this broker, okay? If you want guidance and you want advice, you've got our contact details, and we'll obviously happily guide you when and how we can. But please don't ever be suckered into someone selling you courses or that sort of thing. So just to point that out. Now, good question. Okay, so for all of you out there, for our members, keep those questions coming in. It's important that you ask these questions. Don't be afraid to ask these questions. Okay, if it wasn't for me asking loads of questions in the early part of my career, I might not have been here today as a trader. So the question is, I just watched your footprint market structure and timing video from yesterday evening on the Axia website, which was very useful. I definitely intend to utilize the footprint tool more in my trading. So question. At the start of the video, you mentioned that today is month end and you hope that everyone is well prepared. Well, frankly, I'm not prepared for month end because I'm not sure what characteristics I should be looking for. It would be great if you could explain what is special about month end and what we should be looking out for. Perhaps there is a video in the Axia archives that explains month end flows and what trading opportunities may present themselves. It would be great if you could point me to such a video if there is one available, or perhaps explain one in your future videos. The simple answer is there isn't one. Okay, and that's what this video is about. All right, I'm going to explain month ends to you. I'm going to give you the understanding, and hopefully, okay, what I must say is that, in fact, let's go to the next slide and we can move from there. So historically, all right, beginning part of my career, 2011, 12, 13, hands down, okay, this is pretty much where 90% of traders' revenue was made. Okay, and I mean that openly and honestly. In 2013, it was a particularly difficult year prop trading. There was so little volatility in the market. Nothing was really happening. Okay, there was very little fundamental flow. There was very little technical flow. But there was month-end flow, and month-end flow was, again, a predominant amount of the income that traders made came on one day of the month. Okay, now, the important thing to stress is that month end is a concept. Okay, it's a factual concept, and I'll explain it to you in a minute. It has to happen. There's no two ways about it. It does have to happen. But the way or the manner in which it used to be executed back in 2013 and 2014 is very, very different to how it's executed today. All right, now, what I found in my career is that the best traders are the ones that evolve with the times. Okay. Back in 2012, it used to be, for lack of a better word, free money to trade the month ends. It genuinely was. It was very blatantly obvious when the month end began. Sometimes there was some ridiculous moves in the market. 40, 50 prices with relatively low risk, and a lot of traders did extremely well on them. I never managed to do excessively well. I mean, I made money on it, but I was never brave enough or confident enough to leverage up on those trades. And the simple reason was that I never had a structured approach to it. Okay. And that's what today's stream's about. I'm going to show you a structured approach to month end. I'm going to show you the concept, but then I'm going to show you a structured approach. Hopefully you can take from that structured approach. Now, I'm sure a lot of you are going, oh, but why would you share this with us? Well, it's very simple. Okay, month end is a flow dynamic strategy. In other words, the more people that know about it, the more people that get on with it, I truly believe that I should be quicker than most in identifying it because I've been utilizing the footprint for 4 or 5 years. So in essence, it doesn't sort of it's not to my detriment the more people that understand this. So that's why I'm sharing this with you today. Make no mistake, any trader that shares their holy grail with you, you've always got to question why. So there's the answer to your question: why is he sharing this with you? Okay, it's not going to take from me. If anything, you're going to assist me. Okay, so month end explained in a very simple sense. Okay, hypothetical. I'm not going to go through the theory of it. It's very simple. At the end of the month, portfolio managers, think big institutional pension funds with billions and billions under management, okay, they have got to extend the maturity on their portfolios. Okay, basic example, let's say you have a portfolio that should be a 6, so 60% bonds and 30% local equity, so we call them domestic equity, and then 10% other. Okay, that other could be alternatives, it could be offshore equities, it could be all sorts of other things. Okay, hypothetical, pure hypothetical. Now, at the end of every month, okay, I'm a portfolio manager, I hold bonds, right? Some of those bonds mature, right? In other words, the person I bought the bond off of, right, sends me my money back. Okay. Now my job as a portfolio manager is to always be invested to a certain percentage. In other words, fully invested. That's my job, to be fully invested. Okay. So if bonds mature, in essence, the 60% drops lower. Let's say hypothetically it drops to 55%, which means that at the end of the month or toward the end of the month, okay, when this rebalancing needs to occur, I go and buy those bonds back. So I'm a buyer of bonds. Okay. The same can be said for equities. All right. If equities appreciate a tremendous amount over the course of the month, all things being equal, the percentage of the portfolio will move from 30% slightly higher. Okay, it might move to 32, 33, in which case I need to be a net seller of equities to rebalance that portfolio. Okay. On the flip side, obviously equities can also sell off, in which case I need to be a net buyer of equities at the end of the month. Right, and the same goes for your alternatives. Right? Sometimes there's hedging that needs to be required in terms of currencies. So if I own, for example, a foreign equity and I need to sell that equity, I then need to go and obviously bring that currency back, and there's a hedging effect. Okay, that's the basic theory. Right? Don't quote me on this. Don't go and say Brannigan said this is what month end is. That's the basic synopsis. Okay, I have no clue as to the workings of this because I don't work for a portfolio manager. Okay, but this is the basic synopsis. This is the basic theory behind why month end rebalancing occurs. Okay. So that being said, if we know there will only ever be bond buying, and we know there could be buying or selling in equities, and we know there could be some form of equity, some form of buying and selling in the foreign exchange markets, right? What we can then do is we can actually go and identify certain patterns that occur on the month end. Okay, so this is now where it becomes very interesting, and hopefully a lot of you are going, wow, I've never thought about trading in that way. What we call this, by the way, month end, we call this simply an event. Okay, these events occur in multiple different ways. Sometimes, I hear traders talking about pin bars. Okay, some technical strategy, a pin bar. Okay, a pin bar is nothing more than an event, and it's a price action event. Okay, now if you know that an event has occurred, i.e. this thing called pin bar, right, you can then develop certain patterns to take advantage of that event. Okay, and I'm going to show you how to take advantage of this event called month end. Okay, so why it happens, I've explained that. How it happens, I'm going to show you. When it happens, I'm going to show you as well. Okay, so let's go into it now. Let's start off with just a basic example. This is the German Bund, and in this first section here, okay, you've got the 29th of October. Okay, and this is actually where the month end started now, and this is why I said to you, the best traders are the ones that flow with the times. They adapt with the times. Now, traditionally, month end used to get done on the very last day of the month. Go back to 2012, have a look at the charts, and you'll see bonds rally on the last day of the month. Okay, it was as simple as that. Unfortunately, portfolio managers got a little bit smarter. Okay, they recognized they were being front-runned. They recognized that liquidity was thus becoming a premium, or they'd have to pay a premium for that liquidity, and so they got a bit smarter. Okay, and they started executing the month-end roll a little bit earlier. What that means is that the opportunity is now somewhat disguised. It doesn't mean the buying is not there. It's definitely there. Okay, we know that from one of two things. If you go look at the volume on the daily candles of the month end, you'll see it being substantially higher. And if you go look at the price direction in the days leading up to the month end, you will see prices moving higher. Okay. Now, like I always say to all of our members, don't take what I say as truth. Go and observe it, go and study, go do your own bloody homework. Okay, otherwise you're never gonna learn as a trader. All right, the best traders are the ones that observe, listen, learn, and then go and figure it out for themselves. All right, I'm teaching you how to fish. You've got to fish for yourself at the end of the day. Now that's day one. Okay, and I'm going to show you the price action from down here, and then I'm going to show you day two, which starts here. Okay, and what we can see is a natural appreciation in prices. Okay, the day of month end, which is this third day, notice what prices do. Okay, if you go compare this back, like I said, to 2012, you'll see it completely the other way around. Okay, you'll see the month end day always going up. And this is how it's evolved. Okay, the trade setup has actually evolved a lot where the month end does get done earlier. Now, there's a very logical reason why month end was done 3 days in advance. Traditionally, okay, again, go look at the charts. Traditionally, month end gets done 2 days before. Alright, i.e. the 30th of October. This month it was done on the 29th for a simple reason. We had the FOMC on Wednesday. In other words, portfolio managers run the risk of, if there is a big fundamental in the market, they tend to want to utilize the liquidity when they can. Okay, so when we do have big events, you do tend to see the roll going through a little bit earlier for logical reasons. Okay, now what I want to show you is I want to actually just show you what the price action looks like down here and here. I'm going to utilize the footprint for this because I'm going to show you how, for lack of a better word, how obvious it looks. Okay, and that's the point. It is obvious and it is repeatable. In other words, if you go to the last 12 months, you will see something similar on the footprint. Okay. Now this stream, I'm not going to explain the footprint to you. I'm not going to, tell you why the footprint, how the footprint. I'm going to show you the pattern. All right. If you want to learn about the footprint, that's what the footprint course is there for, is to teach you how to utilize the tool effectively and to actually interpret the tool. I'm going to show you the recognizable pattern. Okay, I'm going to show you what that buying looks like. I'm going to show you where the risk of the trade lies. Right. Now, for a lot of you going, yes, but it's like a scalp. Well, to be fair, 130 prices in less than whatever 35 hours, 40 hours, 130 prices in the German Bund in the current volatility of the market is a substantial move. Okay, it's a really, really significant move. So this is a tradable opportunity. It doesn't matter if you're a day trader, it doesn't matter if you're a swing trader. The point is there's an opportunity for you to learn. Okay, now the second one I'm going to show you is the GBPUSD. Okay, now typically this changes from month to month. All right, I'm not going to explain to you, the nuances behind it, but traditionally we are looking for buy side or at least sell side dollar movements into the month end. Okay, there's good logical reason behind that, which I'll leave for you guys to go and explore yourselves. The point being, okay, we have something similar in the pound, which is a very strong 2-day rally. Okay, 170 pips for those that are not convinced, 170 pips into the month end. Okay, there's our month end effectively, and the market closed relatively close to the high. Okay, so the important thing is, how do we actually observe this? What is it that we can utilize to observe this? And this is where we're going to bring the footprint into it. Okay, now I'm going to go through the footprint on the Bund. I'm not going to go through the footprint on the pound for good reason. I don't believe in giving someone everything. Okay, if you truly want to learn this trade strategy, I'm doing sort of 90% of the work for you. The other 10% is to go and learn it and figure it out for yourself. Okay, I'm pointing you in the right direction. I'm telling you, you get sell side dollar movement into month end, and I'm telling you, you get buy side bond movement into month end. Okay, bonds being US 10-year, German 10-year, French 10-year, all of them go bid into the month end. Okay, not because I say so, but because the market says so. Okay, now what you're looking at is the 29th of October. This is the German Bund, 15-minute rotations. Okay, now very, very typically, one of the most typical patterns you'll see either 2 days before or the day of month end is you will always see the liquidity come to the market on the open. In other words, it's a decision, a tactical decision to be for the participants to ultimately buy at the open of the market. And there's a very good reason behind this, because liquidity should be at its highest come the cash open. Okay, now what we see, and this is the phenomenon, okay, what we see is a very strong price directional move combined with relatively high volume, combined with positive delta. In other words, we see buy side pressure. When we see all blue, just constant blue for 2-3 hours, that's telling us there's buy side pressure in this market. Why? Because buyers are lifting best offers as soon as they can. Okay, so if you go back through the charts and you look at the month ends and the Bund, you're going to see this pattern repeating itself, where we've got a very directional price move, but also a very directional delta move. Positive delta has to be positive. Okay, so what we see is 7 o'clock, market opens up, starts to bid up. Okay, nice bit of volume and a lot of absorption. Okay, so a lot of you will call this absorption, right? Market then moves high. In other words, the buyers come into the market and they're looking for liquidity. They're not aggressive. Okay, if they were aggressive, they would be going up a lot quicker. They're not aggressive. They're just utilizing the liquidity being made available. Okay, now where it's confirmed, now it's what I would say to you is you're not going to get on this first bit. Okay, it's likely you're going to miss this first bit. All right, but this first bit is telling us this is where the month end has begun. In other words, 170.69 becomes an incredibly important pivot in the market. We should not sustain prices below there. Why? Because month end is in the market. Okay, and that's the first and most important thing. If you know where a trade is invalid or wrong, right, you've got an extremely powerful position. Okay, now where it becomes interesting, this is where the real nuance, this is where the opportunity is. Okay, month end, like any trade, doesn't go in a straight line. It always pulls back. Okay, and what you're looking for is you're looking for a significant amount of sell side delta with no continuation. In other words, you're looking for those sellers to enter. All right, and they're very aggressive and they're selling into a very big bid, but they cannot sustain downside prices. Why? Because all they're doing is they're selling into that big buyer that's been buying it since the morning. Okay, and that's this candle right here, 1045, highest volume of the day, 16,000 contracts, 18,000 contracts, substantially higher than anything else. Previous high was 14. Okay, and the highest significant delta on the day, 2,500. Right, what does price do in the very next rotation? Starts to bid up again. Okay, and that's the key. That's your clue. That's your entry point. The moment you get those aggressive sellers after the buyers have told us that they've begun the month-end process, that's where we're looking for our entry point. Where's our stop? Very simply below 69s. Okay, now we're going to see this happen a few times on this day. Right? You'll see the market comes down again. Very good volume. Very good delta. What do prices do in the next rotation? Go back up again. Okay. We see it again late on the day, 26,000 contracts, a very significant selling, very, very high delta. What do we see in the next rotation? Go back up again. Okay, and all that's happening here, think about, remove yourself in terms of the price here and just think about it. What's happening is those buyers are waiting for someone to sell it, for someone to provide some sell side liquidity. They simply absorb that sell side liquidity. Once it's done, they start buying it up again. Okay. Now that's the price action that happened on the 29th. Let's go to the 30th, so the day before month end. Let's see what it looks like. Okay, so the market initially opens, sells off a little bit, runs into some strong sell side again, and what do we start to see? Market bids up, and market bids up. Okay, market keeps rotating higher, higher, higher. Let's see what happens the first time we get some significant sell side action in the market. Okay. In essence, at 12:30, okay, we had the highest, most negative delta, 2,000 a day and 18,000 contracts, and straight away got bought up again. Okay, came in again, 16,000 contracts, nice selling data, got bought up again. Right, the entire session of the 30th, every single sell side delta was met with equal and opposite buying. Let's go to the last day of the month. Okay, let's see what happens on the final day of the month. Market opens, 7 o'clock, and what do we see? Blue, blue, 0, blue, blue. Okay, buying straight from the open, selling, selling, Nice negative deltas. Where does price go? Nowhere. Gets bought straight back up again, and the market keeps bidding higher. Okay, that's it, guys. It's not rocket science. All it is understanding and interpreting the footprint within a specific context, and this is the key. Right? If you put a footprint in, and I've had a few members send me a chart of a footprint, they say, "What do you think this means?" And they send me this chart as though I'm supposed to be able to interpret. And I said, "Well, hang on a sec. The footprint as a standalone, as you share it with me, okay, I can look at it and I can interpret what I think is going on. Okay, and I'm going to look at things like absorption, I'm going to look at the price response, I'm going to look at the volatility, I'm going to look at the volume, I'm going to look at all these sort of aspects, and I'm going to make a best judgment guess, right? But if you throw something into the mix and you say to me, well, the event that occurred was, for example, we had a very big miss in the CPI data from the US, suddenly you're giving me an event. Okay, you're giving me an event where I've got a bit of understanding as to why the footprint is reacting the way it is. Okay, why participants are interacting in the way they're interacting. Okay, and that's what the footprint's all about, all right? The footprint is not a holy grail. The footprint is just simply a tool. Okay, it's a tool that's going to allow me to interpret things based on how, buyers and sellers are interacting, right? In terms of learning that interaction, it's not going to happen just taking a course. It's not going to happen just looking at a chart. It doesn't work like that. You've got to spend hours upon hours looking at things, creating the story in your head, building the story in your head, and eventually you're going to start to notice things like the month-end flow. Eventually it's going to make sense to you. You're going to say, well, wow, actually that's pretty simple. Okay, so thanks for that question, by the way. It was a pretty cool question. And hopefully all of you have got a little bit of a better understanding now as to, what exactly the month end is. Okay, it's not super complicated. I keep saying this to traders. The best traders are the ones that do the simple things perfectly. You don't have to be a rocket scientist. Okay, you just need to be able to interpret things. Wait for that sort of pattern that says to you, you wanted to be a buyer, now's your time to be a buyer, and you simply just buy it. Okay, it is as simple as that. It doesn't have to be more complicated than that unless you choose to make it so.